Welcome back, everyone. This is Mike, your legacy wealth coach, joined again here today with Pei, the income stacking queen. How are you doing?
I'm doing good. Recovering from an awesome weekend that we just had with a pretty large size DIPS meetup plus IBC boot camp that Life Success and Legacy put together. So we were blessed to be in a position to host about 60 people show up at our house.
Yeah. Yeah,
Um,
we were in a space that allowed for 70, and we pretty much filled up the room. So we get to do this, twice a year, live event where, we congregate. This past weekend, again, it was in Houston. Um, they'll have another one in Kansas City in October. So
yeah,
what
you
an
know me,
experience.
I love to host and I also love to talk to people who love to talk about IBC. So that was a combination of two awesome things for us. So super happy to be able to accomplish that. But let's get back to our conversation, a little sneak peek of what we always talk about when we're together.
Let's go.
Yeah.
So last episode, we talked about how investors keep their capital working without interrupting its growth. But there's a bigger question behind all of that, right?
Yeah, I think we touch upon control. And then we also talked about having access to our capital, even while we're deploying it and putting it into investments. The concept of using our dollars more than once, which is unique.
Yeah.
But I think the noise out there, well, this is where we do hear some pushback once in a while about, well, then why not just buy term and invest the difference?
So again, that's a very popular way to look at it, and it's pretty simplistic, right? I mean, sounds logical. The only problem is you're only looking at it or taking that in one direction, where you're thinking about, well, where does that money go or to grow? And ultimately, it's again focused on that accumulation. You have that term, to set up for the death benefit. Okay, great. Now you feel good, but now you have your money, whether it's cash or, through leverage. Now you start investing. Okay.
So the focus on that is accumulation, accumulation, accumulation. And
Same old model. Yeah.
right. But that's not what happens to money while it's actually in motion. Can you unpack that for us a little bit?
Well, I would just argue that, when you think about it, the buy term and invest the difference, you have two things going on. You have that term protection for the, family, for, the eventual, worst case scenario. And then you have the rest of that money that you save, presumably because term is cheap, to start investing with, right? But you're separating them. You essentially have two functions going on independently, right? You're doing it at the same time. So you essentially have your insurance over here, the investing going over here, and you haven't even thought about, well, what about financing, right? Even if you're invested in real estate, you got to get a mortgage, you got to borrow from the bank, and all the while you have the death benefits set here, you have your investment plan here. If you need money, you go to the bank hat in hand as a customer. Okay, so you've got three separate functions going on. And essentially, what happens is you'll lose control of the process in between.
So essentially, you got things happening in silos. They're
That's right.
happening independently. And once money leaves your hand or leaves your system, you don't control it. You can't reuse it until the deal is done and the money actually, you hope and pray that it actually does come back. There seems to be a gap. That's what I'm trying to get at.
Yeah, there's certainly an opportunity here, right? Because again, you're operating in separate silos. It's just, not as efficient as it could be. So that's what infinite banking concept can solve for, right? Essentially, you have these three functions and you can all have them integrated in one coherent system.
So what you're saying is that instead of separating protection, capital, financing in different spots and losing efficiencies as your capital flow through the systems. IBC allows you to put it all
Yeah,
together. So
working
how does that
together.
work? How does that work?
Right. So essentially, you're storing capital within this system, the IBC policy. All the while, you still have access to it without it stopping its growth, right? You have that uninterrupted compounding while you still can use the money from the policy loans. And then when you use it, you're paying yourself back, right? You're not going, to the bank to borrow money, depending on your line of credit or, your credit score and rating and all that kind of thing, and then paying all that interest out of your system to the bank as a customer. With the IBC policy, with your own system, you get to borrow from yourself essentially, and you recapture all that interest.
Yeah, and I think you mentioned that we sort of mentioned that in our previous episodes, and we never actually mentioned exactly where people were storing or where we actually store our
Right.
capital, and that's kind of here. It's revealed. We store it in
Cat's
our
out of
IBC.
the bag.
We store
Yep.
it in our IBC policies, but so now that same dollar, right? Let's bring it back.
Yep.
It can be used, it's recovered, and then reused again. It sounds like the velocity banking concept that we talk about a lot, right? This is where it kind of comes from.
Exactly. You get to, velocitize your money, but now in a very controlled and, tax advantage system that you get to recapture all this interest while it's flowing. And that's something you just can't do with the buy term and invest the difference, scenario when you have these functioning separately, right?
Mm.
Um,
I love that you
yeah,
brought that up because if it's a system, right, that we're talking about,
right.
let's just touch on this. So what happens if the system gets interrupted? And there are, I guess, two ways we see of the system getting interrupted. One is if something were to happen to you, the operator of the system. And
Right.
then the second one will be what happens if the underlying investment, if something
Go
happens to
south.
that investment. Yeah, those two things. Can you
Okay.
touch on that?
Sure. So let's talk about the first scenario, right? Worst case event, something happens to the operator, the investor, myself, right? We pass away. Well, there's both methods, if you would, has death benefit. The term has a static death benefit that will hopefully make whole the family or whoever, but it doesn't grow. Okay, it is term. It's good for that 20 years or whatever the term period is. Death benefit on the IBC side as well, but this is a different type of death benefit. Being permanent life, it is actually increasing every year. So that both systems have that somewhat covered. I think one better than the other, obviously. But the other scenario, well, let's say your investments go south, right? It doesn't come back, or it's gone sideways. When you have the buy term and invest the difference, presumably you're either invested just in your own cold hard cash or you're leveraging it from the bank and again paying out all that interest. Okay, so you're going to have to, essentially recover that yourself. And until you do so, that money is gone. And that investment not to come back, you've interrupted that compounding, cut it at its knees. On the other hand, with the, capital that was borrowed, let's say from your policy's cash values, that money, okay, now it's locked up or it's gone sideways. You still have, however, because it's collateralized, the value of your policy and the cash value, right? The death benefit, all that is still intact because the money never came out of your policy. When you borrowed to invest, okay, yes, that net value is decreased, but the asset remains whole. And I always say you have that collateralized asset here and the money that you borrowed and used here. Now you want to repay it and put the piece back on the shelf, like Nelson said. But until then, it's going to cost you some interest. That's still much better than having nothing on the other side that you have to replace. And until you do, all that growth stopped. Here, your cash values, your policy, your death benefit continues to grow. And you have time, okay, to replenish those P's as you can, get, that capital flowing and growing again. So
And
it's very different.
essentially, with when we're incorporating, velocity banking into this process alongside with the IBC system, it helps the death benefit piece. It restores everything when something were to happen to the
Yes.
operator, and same thing with the something were to happen mid-cycle in your investment, something was to happen, it just sounds like it's
Yeah.
go ahead.
And I'll add another piece to it. Okay. Let's assume, okay, both operators, okay, passed on early and the investment went south. Both operators borrowed money, right? One from the bank over here, buy term and invest the difference. Because remember, you don't have that banking function that you can own and control. Whereas over here, you borrowed from yourself or from your own system. Okay. What's the implication to your family now that you're gone? Well, hey, maybe you borrowed 100,000 or $500,000 for this project. Here, there's creditors involved. They want their money back, right? Just because you pass on, hey, it's not extinguished, right? Now, that death benefit, that term may help out there, but that's a separate piece that doesn't, isn't cohesive, and it's certainly not dollar for dollar equal. On the other side, because this is all within the IBC policy and system, any cash value outstanding loan that you may have, even if it's not repaid, okay? Once you pass on in the worst event, that death benefit is going to make you whole, pay off all the principal, all that interest, and there's going to still be a substantial amount of excess that will continue to flow to the family. And so very different, implications for, if you're left holding the bag and God calls you away early. Yeah.
So it also sounds like that death benefit in the IBC system comes back to allow you to maintain control. So because, let's say it's real estate investing that you're in or whatever portfolio, immediately you might not be able to liquidate. There's a lot of situations that could happen that delays the liquidation event, but having that system protected using the IBC system just seems like a more connected the system. That's what we're very focused on, right?
That's right.
Yeah.
You have that, like you said, it goes back to the advantage of having it within a cohesive system that you maintain control over, that remains, compounding uninterrupted, and that has essentially a guarantee for any activity that you do through that death benefit. And that benefit is super important. A lot of people kind of miss out on. Mm-hmm.
And I think, in our coaching sessions with our DIBS community, we always bring that. We always kind of miss that or not it's not always front and center. So that's why we're having this conversation today, because we are so focused on the other pieces of IBC, and we tend not to discuss that piece a lot.
Mm-hmm. That's right. That death benefit, gets short shrift, but it's unfortunate because really it's the backbone that holds it all together, that makes all these, multi-functions possible, within that one system. Again, it guarantees all that capital that you can deploy time and again through the cash value as equity within that policy. And it, again, will pay off anything that don't pay back, at the end of the story. So there's no need to get it guaranteed, elsewhere. If you're going for a bank loan, put up, your capital or your W-2, your income, or, even your house, put a lien against the house. You don't need any of that when you have your cohesive system within a policy.
That's cool. So hopefully you're starting to see the difference. I'm talking to our audience or whoever's watching now. You're starting to see the difference between just investing, right, versus actually building a system around your capital or your money. And if you want help putting it together, I can't think of a better community or coach than working with Mike. And this is what we love to do. And I just encourage people to pick up the book with Nelson Nash's book, Becoming Your Own Banker, pick up your book, Dips on Your Money, and continue learning, and schedule a call with you to just talk about what you already currently set up, having a strategy session. And I think that's just what we always want to encourage people to do. And that's why our community is growing, essentially, right? So
Yeah, I mean, I love talking about this stuff and thinking through it with you and sharing what we've learned over the years. And I look forward to talking to anyone, about this. If you have questions, let me know. Let's chat. Thanks again for tuning in and joining us today. Until next time, peace.